Hey, I'm Karl Kyler, your San Diego realtor, and I'm back here with Matt.Kish, lender extraordinaire, our local lender extraordinaire with Movement Mortgage. Kish, thanks for coming back on this bi-weekly report so we can update our audience with what's going on with the market.
Always a pleasure. Thank you so much for having me. Let's get it going.
So Kish, tariff talk has been bouncing around like a pinball. We're having them, we're not having them, they're going up, they're coming down. Trump settled something out with the UK. The big one that happened over the weekend was with China. Then we saw the markets explode over the weekend. Can you give us any insight on how that is impacting the mortgage side, or maybe it's just impacting the consumers? Like, what are you experiencing on the loan side with regards to like buyers or sellers and refinances? How is that affecting the mentality of what's going on in the real estate market?
You know what? Fortunately, loan applications on my end, I don't know about in mortgage, overall, but as far as Movement Mortgage and Eddie's team and Matt's team, we're doing great this week. A lot of news came out. Confidence is a little bit better and bigger when it came news for the tariff talks with China. So confidence seems to be building traction, but again, like we spoke about a little bit last week, a day of good news or bad news could really sway the pendulums in these markets. The stock market got better with news of tariff talk. The mortgage and bond market, not so much. Some of the other reports that came out this week made the bond market a little bit better, especially yesterday. But it's a moving target. This thing is going to be moving, especially with a new president, new policy, new economics. So stay tuned.
Yeah, I was very, very fortunate to get into Tesla when it was around like $2 or not $2, $230. And then it jumped to like $340 or something. So that's kind of an interesting question, is with the resolution or settlement, whichever word you want to pick, between China and Trump, recession talks were freaking everywhere, right? Then overnight, boom, just like that. Like you said, the pendulum swings, and then Yahoo Finance, MSNBC, all of these news reporting platforms are posting recession over, recession canceled, just like that from a single talk with China. What are your thoughts? Like, is a recession still possible? And honestly, is it something we have to worry about in real estate if the recession does happen or it doesn't happen?
Well, we don't know, right? There's still many factors out there that says, hey, there's still recessionary signs that may hit. And there's still geopolitical factors that may hit us too. There's wars going on in Ukraine and Russia, Afghanistan or Pakistan and India, right? So there's a lot of other factors that weigh into our recessionary indicators as well. What I do know, and what the data shows, is that directly during and shortly thereafter recessions is interest rates come down. What does that do? Is that's going to create a whole new pool of buyers, but at the same token, that's going to increase home prices, because at the end of the day, it's still simple economics, supply and demand. There's only so many houses out there right now. Rates come down, maybe a few more, but there's still only so many houses out there for the few people that need to buy them.
Yeah, that's a really, you bring up a really good point. So you said at the end of a recession, typically rates come down, not during a recession.
Right, because it's all lag factors, right? You have to perceive, we feel the crunch in the recession, but the Fed and the policies that are made by the Fed are kind of in the rear view. So it's going to take months of compiled data to really sway the Fed's pendulum to make monetary policy, to lower interest rates, and to do these things to really benefit the people who are struggling. But it's going to take time. We're going to feel it in the now, and policy is going to be made, sometime in the future.
Got it. Okay. So recession hits, lag factors, rates eventually come down, and then that would drive the market with regards to real estate sales prices.
Right, because now those folks who were on the sidelines, who weren't able to afford, or it would have been really hard for them to afford a monthly payment on a home with interest rates in the mid to high sixes. Now they're in the low sixes, high fives. What does that do for their monthly payments and their monthly budget? Makes it a little easier, but at the same token, what does it do for these home prices that are now going to be in bidding wars because there's so many more people flooding to the market as far as buyers are concerned, with few homes out there for them to buy.
Got it. So I'd like to just rewind or step back a little bit in regards to consumer confidence, which we kind of touched on a little bit ago with regards to like how the stock market bounced back. It seemed like with all the recession talk, a lot of buyers were withholding because they had the concerns of the recession talk, but also it was kind of like messing up their accounts. So buyers who borrow from their 401ks, or buyers who have a lot of their money sitting in their like trading portfolios. Like I have a lot of clients that send me E-Trade account, like printouts for their proof of funds, but they have it like tied up in stock. When that goes down, then their liquidity, I'll say that very loosely because it's tied up in stocks or whatever, that liquidity just disappears like that. So did you, or are you seeing, I know it's only been a week, are you seeing consumer confidence bounce back like the stock market did? Or do you have a little bit of hesitation? Like tell me what you're seeing from consumers.
It's still hesitation, right? There's a few people out there who are still very interested, who are coming up on leases, right? I'm running into a lot of that right now, is folks that are backed up into re-signing or renewing a lease. It's, should I buy or should I renew my lease for another year? A lot of conversations, a lot of new first-time home buyers. But still, there's still a lot of people that are hanging out on the sideline because they've seen the peaks and valleys just in this short period of time with the new presidency, what it's done to the market. Again, going back to a day of good, bad news could really sway how these markets react, right? And the stock market is usually inverse. Usually, I say that very lightly, usually inverse of what the bond market's doing. The bond market is very tied into how mortgage rates are working. So when the stock market's going crazy like it did, the bond market's usually taking a hit because people are taking their money out of the bonds and putting it into the stock market.
Right. So help us understand that a little bit, if you don't mind. If people pull their money out of bonds, they put it into the stock market, that would mean that the bond market has to increase the rate of return to try to bring people back. Is that right?
Yeah, the yield spread gets different, right? Because people are taking money out of the market, so now these things cost more to get them, right? Because that's just the way it goes. So if one is, imagine it as a seesaw, right? If one grows, the other side goes. So it's the all ever struggle to keep these things at even. So that's where we're at, and that's what our hope's for. But when the stock market's usually having a day, the bond market is usually having a day.
Got it. Okay. Makes very much sense. On top of the tariff talks that have been slowly progressing, we also had consumer price index, the CPI, as well as PPI, producer price index. Is that right?
Correct.
So we had both of those report this week. They came down, CPI and PPI came down lower than expected. Core CPI and core PPI came in as expected. Now, I don't think we need to go into the micro details on this. Like, this is not an economics report or anything like that. But can you tell us if that is having any impact on the loan market? Are these like metrics that buyers should be mindful of? Like, is this going to affect their mortgage rate?
No, not specifically, but it's good news, right? Like getting down to where the Fed wants as far as core numbers, getting closer to that 2% mark is where the Fed said before they're going to lower rates, right? So once we get closer to that 2, hopefully things get better as far as the rates are concerned, and that's obviously going to go back into the consumers' pockets. But it's definitely good news. Getting back to what's swaying these pendulums these days, it's news, and everybody's sitting there watching the news and waiting for repeated good news. Because right now it's, hey, today's great, and then tomorrow it's, oh wow, what happened? So we're still there, and the Fed feels that too. Until there's consistency and they really know which way this thing is going, it's gonna be peaks and valleys until then.
Okay, that's good. So I'm curious. So there's like a lot of this volatility that consumers are seeing on the news, which has them coming and going. Then we also have, California is one of the main states experiencing massive volatility, and not in the good way when it comes to homeowners insurance. Like, I think it was State Farm that just had emergency approval to raise their premiums up. I think it's 17%. Don't quote me on any of this. If someone's watching, they're going to write in the comments, oh, you're off, bottom line, State Farm was approved to raise their premiums because all the stuff that happened in the Palisades. But I'm curious, like the consumers watching the, essentially the news reports and that confidence in the market swaying, do you feel anything with regards to homeowners insurance also affecting consumer confidence in the real estate market?
Not as far as the confidence, but it's something that we're very, very more cognizant of than we would have been more so than a few years past, especially with the fires that's happened in California, whether that be in the LA County, San Diego County. Every county is on fire. There's a fire season, right? And so when it comes to shopping for mortgages, you should be shopping for homeowners insurance just as vigorous, because there's fewer policies out there, and the policies that are available are harder to get, and they're more expensive to boot. So it's a tough place to be in. Buying a house has gotten more expensive, and that's just the case, and that's the facts of the matter. Property taxes continue to go up, especially with new builds. There's Mello-Roos attached to those property taxes as well. Homeowners insurance continues to grow, especially when you have to add the Cal Fire aspect to it here in these high fire areas. With the interest rates being where they're at, we're going to see where that flood of buyers comes from, right? With these high insurance premiums, higher property taxes, right now, quote unquote, high interest rates. As soon as one of those three buckets gets a little lower, there's going to be a flood of people ready to react to that. And I believe it's going to be interest rates first, because like you mentioned, these homeowners premiums aren't getting any less expensive. And correct me if I'm wrong, I don't even think State Farm is writing policies in California. I think that's just the hike in premiums to existing borrowers.
You know what? I do a weekly video, San Diego Market Matters, and you're right. I don't know if I want to agree with you that State Farm isn't writing policies anymore, but this number of 13%, like they canceled 13% of their policies and then they retained something like that. Either they stopped writing and they retained policies, or they stopped writing and then cut some policies off. But it's a mess out there right now. So yeah, back when I started in the early 2000s, this entire time we rarely ever paid attention to homeowners insurance. And now it's like a major issue for almost every buyer. Like if I'm in escrow on a house where it has like a 15-year roof, that is a hurdle when it comes to my clients getting homeowners insurance. So hopefully the mortgage interest rates will break soon enough. That will create a little bit more relief for the buyers trying to get into the market. And, maybe the tides will turn that.
Yeah, and that's the hopes, right? Is wait for the interest rates, wait for something, but we all know what it is to wait. The more you wait, the more you're losing out on that appreciated gain of getting into that property now. We'll be able to refinance when the rates do come down. So it might be even more affordable to get in that place today and saving a buck or two tomorrow than you would waiting on the sidelines anyway. But it's all definitely case-by-case basis. But we know that homeowners insurance isn't getting any cheaper. Property taxes are going up, and rates are what they are. And we should be getting into a home if you could afford it, you got decent credit, and you have some money saved away. Should be having that conversation.
Yeah, I agree with you. That is one of the main conversations I have with clients when they ask me if they should buy. I say, well, that's a personal question. You got to look at your own finances. But the fact of the matter is that it's the chances of what it costs to live here going down is just so low. So many people are like in hopes of that 2008 crash. It's really, really unlikely. So, it is what it is. What I'd like for us to cover last, could you give us insights? Any expectations? Obviously, we're not going to hold you to this because, again, things change with what Trump is eating for breakfast, it feels like. Could you give us any insights on what we can expect between now and the end of the month of May in the mortgage market? Maybe with rates, maybe with new programs, maybe with underwriting conditions, anything. Any insights as to what you think could happen between now, or what you expect to happen between now and the end?
What I expect and what I think and that stuff, I would be on an island talking to you if I knew, right? But just the trajectory of where the 10 years at, good progress. Hopefully that keeps coming down, because the 10 year is really going to sway where these mortgage interest rates are as bond market is concerned and not policy is concerned. But hopefully recessionary factors keep lowering. We get close to that 2% mark, and Jerome Powell's going to have, his hand's going to be forced because that's the mark he wanted to hit. And so now lower these interest rates, right? So hopefully that's twofold, and hopefully we can get some consistency with what's going on with monetary policy. That way we could actually foresee what's going on and answer this question with a little more confidence. But right now, just like consumers, we don't really have much confidence talking to people other than just being available and having this news for them at our disposal. Right now, the end of the month is a great economic report coming out, and hopefully that tells the story of what these tariffs are doing to these markets. So we have a little more insight of what to expect going forward. But a lot of the data that we're seeing right now just doesn't have any of this tariff stuff attached to it. So we really got to wait and see what that does to the consumer when that data is implemented. So we're crossing our fingers. Hopefully we get more days like yesterday than we do, Monday, as far as bonds are concerned, as far as good news on that front. But we're going to wait and see. We'll hopefully have good news on the horizon.
You bring up a good point. So all of the data we have right now has been lagging. And you mentioned at the end of the month, we're going to get some data that comes in, which is going to show the impacts of tariffs. And so you're suggesting that could possibly be a tipping point in one direction or the other with rates?
It's just going to be this kind of the show, right? It's just, hey, maybe there's going to be some tariff stuff attached to this PCE report that's coming out at the end of the month. But again, it's going to take time, even if there is some attached, for any policy to change. The markets might react one way or the other for a day or two. But again, for anything to really be set in stone and for anything to come out of the Fed, we're going to need to see that data at a consistent.
Got it. Makes sense. I heard an economist say that rates have, what they're doing now is pretty much what they've been doing for the last 2 months. Do you think that is probably safe to say for the next 2 to 4 weeks, maybe?
I would say it's safe to say at least till that report comes out. And like I said, that might sway the pendulum for a day or two. But again, until there's actual policy or until something as far as global economics is concerned to really sway this, it's going to stay flat. Like you said, it really hasn't moved one way or the other. It's tested levels of support as far as, the numbers are concerned, but it's bounced off of those levels and come back to where we are today. But if you pull the charts out, it's been flat across the board for a little bit. So we're waiting for it to get better. Again, the telling sign would be, if you're looking at the treasuries, look at the 10-year note. We need that thing closer to 4%, and we'll be in business as far as like rates are good and getting into refinances and things of that nature. You'll see some people coming off the sideline, but it's tested that level that like we spoke about a couple weeks ago. When rates got really good for about a 24-hour period of time, that was when the 10-year got below 4 for a day. We're hoping for that. We're hoping for these markets to react well, and we're hoping to get some better news as far as rates. But until then, we're just kind of got our seatbelts on.
It seems like when we have moments of like high reactivity in the market, you say it so well, it lasts for like a day. So what we're really looking for is a less reactivity and more of a gradual progression in one direction or the other. And that's just going to come with time, which I very much agree with you. So anyways, thanks for showing up for the bi-weekly talks with me, giving the audience the update on what's going on in the market. If you are looking to buy or refinance and you need a lender, Matt's local. He's here. He's a local lender with Movement Mortgage. I'm going to have his contact info in the description below. Call him directly, email him, whatever you'd like. He is an invaluable, absolutely invaluable resource for you if you're looking to buy in San Diego or if you're looking to refinance. If you have any thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.